She's going to mitigate her inheritance tax in the future, so she's happy about that. When her company pays the rent to her SAS, the company gets tax relief. So again, she's very happy about that, and she won't have to pay any future capital gains tax on the commercial property because it's in a SAS. So she's very, very happy, ecstatic in fact, that there won't be any future capital gains tax liability. Now let's spread this over the next 10 years. It's that time of the week again. It's Finance Friday. And before I go any further, I want to make clear that this isn't investment advice. I am not qualified to give investment advice, and neither does my insurance cover that. So I'm just sharing information with you more around the tax benefits of SAS. So let's have a look at this scenario. Let's look at a scenario and say we have a person, and let's call them Julie, and she's a higher rate taxpayer, and she wants to take an extra £40,000 out of her limited company. Now to do that, she wants to take a dividend. And in order to take a £40,000 dividend from her company, she actually needs to take out £59,259, because obviously she'll have to pay income tax to get a net figure of £40,000. On top of that, in order to actually take out £59,000 from her company and a few more pounds, the company needs to make pre-tax profits of just over £73,000, 73,159 to be precise. Hi Helena, thank you for joining us. So the company has to make £73,159 in pre-tax profits. She takes out ends up with £40,000 net in her pocket. That means she and her company together have paid £33,159 in tax for her to have an additional £40,000 in her bank account or her back pocket, which is a lot of money to pay. And just to put that into perspective, the average UK salary is £30,240. So she'd be paying more tax than the average person earns in the UK. So that's a lot of money. Now, when we're talking about SAS, in terms of tax, what the kind of key benefits or things you need to consider or be aware of is, number one, SAS is an effective way for you to extract profit from your company or your business and to put it into your SAS. It also, when you move money from your company into a SAS, you get tax relief, and you can pay up to £40,000 every single year. You've got the carry forward and some other amounts you can transfer, but I'm not going to go into that. So if you save the tax, which I've just shared with you, which is £33,159, plus the tax relief that you get on the £40,000 when you transfer money into your SAS, that gives you a very sizable saving of £47,600. So that's very significant. And hi William, Christopher Campbell, and thank you for joining us. So the key benefits really are, it helps you to reduce your tax year on year as long as you're making payments. It helps you with your estate planning. It helps you with your retirement planning, so you've got income in the future, and gives you or protects your assets, because obviously if you buy, let's say, a property in a SAS, then it's in a separate entity, which is a trust. So you're kind of ring fencing that away from your existing trading business, which is a good thing. Let's now look at a scenario where, let's say you've got, you're paying £37,500, so £37,500 per year in rent. Sorry, not paying, you're earning that. So you've got a commercial property and you're charging £37,500 rent to a tenant. When that money comes in, after you've paid for all your expenses, you'll have to pay income tax on the profits. You'll then have to pay capital gains tax when you sell that property. It's going to form part of your estate for inheritance tax purposes. And if you're renting that property to your company, let's say, to your trading business, then your trading business will get tax relief on the rent that it pays you personally. Let's take that a step further, and let's say Helena, who's on the call here, say she bought a commercial property, say 10 years ago, for £225,000. Today, it's worth, let's say, £375,000. She doesn't have a mortgage on it. There's no option to tax, so that there's no VAT issues whatsoever at the moment. And Helena goes to see her IFA, and at the same time speaks to her tax advisor and says what she's looking to do is reduce her income tax, reduce her capital gains tax at some point in the future, reduce her inheritance tax exposure. She wants to create future assets for her retirement. She wants to be in a place where she can grow her pot quicker by being more tax efficient. So the tax that she saves, she can reinvest that into future capital appreciating assets. And she wants to make sure any assets that she buys, some of them are ring fenced in a SSAS or a separate entity, so that they are protected, and that will give her peace of mind and security. So at the moment, looking at our initial scenario, Helena is renting her commercial property, which she bought for £225,000, to her trading business, and the trading business pays her rent. What she could do is she could sell her property to her trading business for £375,000, because that's the market value. She'll have to pay capital gains tax on the capital appreciation from £375,000 less the £225,000, which is how much she bought it for. There won't be any VAT implications because there's no option to tax. There'll be stamp duty, land tax payable because there's a disposal. So now the company owns the asset, which is worth £375,000. The company can't pay her for the asset, so therefore there's a director's loan, so there's money owed to Helena, which is obviously £375,000. Now, when the property goes into the SSAS, into the limited company can then sell that to your SSAS or to Helena SSAS. So any future rent paid by the company won't go to Helena because she doesn't own the asset. That goes directly to the SSAS. And the SSAS isn't going to pay any tax on the rental income. The property is secure, so Helena's more comfortable. She's going to mitigate her inheritance tax in the future, so she's happy about that. When her company pays the rent to her SSAS, the company gets tax relief, so again she's very happy about that, and she won't have to pay any future capital gains tax on the commercial property because it's in a SSAS. So she's very happy, she's ecstatic in fact, that there won't be any future capital gains tax liabilities. Now let's spread this over the next 10 years. So if Helena's paying £37,500 rent every single year, over 10 years, that means £375,000 will go into Helena's SSAS. If that were still owned by Helena, she'd have had to pay tax, and she would have been left with a net figure of £225,000. So on average, she would have paid £150,000 in tax, which she's not going to pay now because obviously the SSAS isn't paying any tax. So she's very happy that £150,000 she can now invest into other capital appreciating assets, or she can loan the money and charge interest on it, so she can grow her SSAS very quickly. So Helena's got £375,000 sat on her director's loan account, which she's going to draw down. If she didn't have that and she wanted to draw down £375,000 from her limited company, and if she's a higher rate taxpayer, she'd pay 32.5% dividend tax. That means she would pay HMRC £121,875 in tax over 10 years. Now, because Helena sold the property from herself to her company and then to the SSAS, she'll have a capital gains tax bill, and let's just say for the purposes of this conversation, that equates to about £25,000. On top of that, there would be stamp duty payable of £8,250, but her company saves corporation tax on the rent it's paid at 19%. So 19% of 375,000 is £71,250. So the total saving for Helena is the 159,675 plus the 150,000 from the tax. So the overall tax saving in total, and I know I'm running through this example pretty quickly and you've got no numbers in front of you, but the total tax saving for Helena over 10 years is £309,675. That's just over £30,000 per year. £309,675 saving. Now, once she sold the property to her company and the company then sells it to the SAS, you might be thinking there might be SDLT payable twice. There is sub-sale relief which Helena could use so that she only pays the SDLT once. Again, you'll have to speak to a property specialist. I can help with that. There are other people out there too, of course, who can help you with that. So you can see there's a gigantic saving by Helena moving her commercial property, if she has one, to the company and then into the SAS. She reduces her income tax, capital gains tax, inheritance tax. She saves on the corporation tax and she's got more money to reinvest. So over 10 years, she has an additional £309,000 to reinvest. So you can imagine what she'll be able to do with that money every single year over 10 years. She'll hopefully quite easily double that and she'll have a very big amount in her SAS. Then when Helena reaches 55, she can draw down 50% of the value of her SAS tax-free. So that's an additional benefit which she's going to look forward to when she's 55. So those are some of the huge tax saving potentials that somebody has when they are looking to use SAS as both a tax saving and an investment strategy, and it's really too big to ignore. So I hope you do consider SAS. Even if you don't have a commercial property right now, you can make contributions from your trading business into a SAS, and that's going to serve you exceptionally well. So consider that, and I hope you find this useful. Until next Friday, have a fantastic weekend, and I'll see you next Friday. Bye for now.